Hi, my name is Joel Hooper, and today we're going to be talking about three different topics: private placement memorandum, term sheets, and the due diligence that goes into those two things. So let's go ahead and dive on in. What is a private placement memorandum? Well, when a company wants to raise funds or capital for a certain venture within the company, maybe a project, maybe an idea, possibly an opportunity that's on the horizon that they need a lot of capital for, they can turn to a private placement memorandum versus going public to raise those funds. So usually the investor group is handpicked by the company. The SEC kind of requires it to be a smaller, more select, exclusive group, such as higher ups within the company, sometimes employees, sometimes even family members and other accredited investors that really have a really great grasp on how the company is, where they're growing, how healthy they are financially. Now, because it is done privately, and as I mentioned, it does still go through the SEC. However, there is an exemption that allows them to kind of get away from certain disclosures or reports that might need to be done annually or quarterly for publicly traded stock, that this required them not to necessarily give them those forms. So therefore, it's a little bit more risky for the investor. Therefore, the company usually compensates them fairly for that risk in the form of discounted securities. So PPM kind of gives more of a little bit of detail, just a broad detail about what the security is, kind of the terms, objectives, and some of the risks that might be involved. However, it is a pretty broad kind of test in the waters to see what investors may or may not be interested. And once they do find a investor or investors that say, hey, I want in on this, they move to the term sheets, which I will cover next. As previously mentioned, the private placement memorandum is more of a very broad document, kind of to test the waters, see which investors might be interested in taking the next steps to move towards purchasing and getting in on the ground level, maybe investing in this company. So then from there, once we find those interested investors, then we can jump into the term sheet, which breaks it down into much greater detail. Things such as the actual terms of the agreement, the maturity, price-wise, things like that. Also, are dividends paid out? If they are, how much? What's the time frame? Annually, quarterly? Those kind of things are really broken down into there and also negotiated within there, because the term sheets are not a binding contract yet. It's kind of setting it all up, and if the two parties can come on to agreement, then great, we'll move forward. So some other stipulations that I found interesting within the term sheets was a thing called pay to play. So once an investor invests in this company, gives them their money, maybe gets some stock back in return, say they receive preferred stock. Now, the company comes back to the investor and says, hey, we need a little bit more money to fund this or fund this opportunity or project, whatever it may be. That investor must pony up, as they say. And if they don't, give over a little bit more money that the company is asking for, they're at risk to have that preferred stock with those certain voting rights bump down to common stock, maybe not receive dividends as often or have that voting power that they otherwise would if they did pony up and give more money. So those are one of the stipulations that can be in the term sheets, again, negotiable. Next is, what are the liquidation terms on this? Typically, in a private placement memorandum, in the private setting, it's typically 5 to 7 years before maturity. Again, that's just on average. But that does mean that there is, as I mentioned previously, a little bit more risk involved. Therefore, the company is compensating them for that risk. Lastly is the registration rights and the voting rights that come along with it. Kind of breaks down, well, what percent did you put in? How much did you put in? What percent is your voting rights? It breaks down those different aspects of this security and what comes along with it. So to kind of wrap this all up, private placement memorandums, more of the broad kind of looking to see which investors are interested. Then, if they are, take them into the term sheets where all the details can be broken down as previously mentioned, and it is only then that you have done your due diligence, looked at financials, health of the company, growth, what the objectives are, and what the risks are.